It's an easy trap to fall into as an entrepreneur or as a startup founder, to think about what you need and what would be good for you and whether or not this partnership will help grow your business. It's much harder to put yourself in the other shoes. What do they need in order to make this successful?
Hi everyone, I'm your host Rohit Bhargava, and you are listening to episode 162 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors and operators to unpack their journey, lessons and insights to help current and future entrepreneurs. The voice that you heard a little bit earlier was that of Dan Peters, the Managing Director for ClearCo Australia and our guest for this episode. ClearCo provides revenue-based financing for e-commerce businesses. Through their data-driven approach to capital, they've created a platform that funds 8 times as many women as traditional venture capital funds, and according to a study in the UK, 25 times as many founders that identify as people of colour. In this episode, Dan also shares some of his own journey and insights from co-founding and successfully exiting a legal tech startup in the early 2000s, as well as most recently co-founding LimePay during the pandemic. We also discuss topics such as how to build and hire for high-performing teams, the importance of benchmarking, and why founders really need to know their metrics and numbers. Speaking of numbers, you want to make sure that you have someone either internally or externally to help you manage your finances, especially as you continue to grow. I've personally been using the team at Sender to manage both my personal and business accounting needs, and can say from first-hand experience that it is so helpful to have someone that can take care of this area for you. Sender is more than just an accounting firm, and they have a dedicated focus on founders, funders and startups, and can help you with everything from managing your taxes and balancing your books to even helping with your exit strategy. To find out more, head over to sender.com. And whether you're taking in capital from a VC fund, an angel investor, or even a revenue-based financing provider like ClearCo, you want to make sure that you have the right legal infrastructure in place without having to pay a large chunk of your new capital on legal fees. LawPath's legal advice plan gives you access to lawyers on demand for one low monthly fee. You can create documents, sign online, and even have a lawyer on call to help with any legal issues. They've helped save Australian businesses over $100 million in legal fees and are offering Startup Playbook listeners 20% off their most popular plan. To get access to this exclusive offer, head over to lawpath.com/playbook. And as Dan mentions in this episode, one of the keys of building a high-performing team is to surround yourself with the right people. Having gone through the journey myself, I know how difficult that can be, and that's why I'm excited to partner with Dovetail Studios. On top of being a renowned product development partner for startups like Afterpay, they also have a VC fund that invests in early-stage companies that go through their Venture Studio program. So if you're an early-stage, non-technical founder looking to build the right team around you to help supercharge your growth, head over to dovetailstudios.com. With that out of the way, and without further ado, here is my interview with Dan Peters. Hi Dan, welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
No problem. Great to be here. Thanks, Rohit.
Dan, for those people that may not be as familiar with you or your background, do you want to share a little bit about your story and what got you here today?
Yeah, sure. So I guess I would describe myself as a kind of a lifer in technology and platforms. I originally a POM from the UK, but came to Australia on September 11th, 2001. Strange time to be flying in, and I've spent the 20 years here in a variety of kind of different roles, from startup through to 13 years at Google, and then startup again, and then now with ClearCo bringing a global scale up to Australia. I guess the thing that unites that through my journey has been kind of a somewhat an entrepreneurial hunger or itch to scratch. And so, for example, when I joined Google, Google wasn't Google. It was 50 people in Australia, and we were doing things for the first time. And then by the time I left, we were 3,000 people and kind of what people know of it today. So I've never really worked in corporate in my life, and kind of always been I guess an entrepreneur or at heart that's been working through those. And I'm happy we might dive into some of those experiences through this chat, but it's I guess my persona and my journey has been one of kind of bringing my entrepreneurial desires into business.
Yeah, and as you mentioned, we'll dive into some of the work that you're doing at the moment with ClearCo. But just going back to your background, I think there's a lot of similarity between us. I had a former startup, spent the last couple of years at AWS, and recently left as well. And I guess from an outside perspective, you sort of imagine there's kind of thousands of people working there on kind of a single problem, but it's very different on the inside. And I know for me personally, there were so many lessons that I took away in terms of kind of business processes and just kind of operationally that helped me sort of feed into what I want to do next. But I guess from your perspective, from when you joined Google in the early days, what are some of the lessons that you sort of took away from that you were able to apply to your own businesses or into the work that you're doing now?
Yeah, look, it's fascinating, right? Because I did have the opportunity and privilege really to join a business like Google at a time when it was still young enough to be kind of working out a lot of the kinks of its business model and kind of still, I mean, it was a couple of years post-IPO, but it was still really just still scaling compared to where it is today. And so, for example, in Australia, we hadn't launched YouTube. If you can imagine a world before YouTube, and we had launched YouTube, but we hadn't launched advertising on YouTube. There were no ads on YouTube at all, and so that was a time when people were still asking, how will this thing make money? And so we were doing the first deals with the TV networks, for example. We were doing when we bought Android and did the first, I did the first kind of telco deals with a lot of the telcos. When we as some people may know who are viewing this, Google Maps was originally like an Australian business that Google bought. So we did some of the very first map content license deals in the world out of Australia, which I was kind of a part of and was kind of doing some of those. And those were kind of really exciting times. But what you learn when you do those in a global business is, those first of kind of deals are, that's when you're really kind of trying to think through the business problem of for the very first time of how does YouTube partner with a TV network, for example? How does Android work with the telco? And these are ongoing problems. You don't solve them immediately, but at the outset you're really trying to formulate the initial kind of go-to-market plans. And so as I've sort of taken a lot of those kind of learnings, and there's just been a lot into my startup that immediately followed Google, and then now ClearCo. ClearCo is actually a far more comparable state of scale up to when I joined Google, and is solving a lot of those problems literally for the very first time in exactly the same way. So we're trying to work out, in ClearCo's example, how do we partner with e-commerce platforms for the very first time, and what do those business models look like, and what do those go-to-market strategies look like? I find that fascinating. It's kind of been the most interesting, I think, part of my career is taking the learnings from how a phenomenal business like Google did it and applying them as best as possible to something like ClearCo. So I think that's been great learnings. Yeah, sorry. Go.
No, I was just about to say, just wanting to dive a little bit deeper into what you just mentioned. There are certain layers of complexity that come from working at a company of the size of Google when you're sort of building those partnerships. But I guess for the benefit of the listeners that are looking to sort of build out their own sort of partnership model or structure, how do they sort of navigate those layers of complexity when you are sort of negotiating different terms? What are the things that they should look for, or how should they go about approaching that?
Yeah, I think one of the great lessons is when you're thinking about if we're going to talk about partnerships specifically, and I'm a huge advocate for and think a lot about partnerships, because it's, especially in the startup world, it's such a way to scale. Like it is, and it's kind of, if we just step back for a minute, actually, it's one of the kind of untold secrets of Google, right? It's not actually talked about an awful lot about in this story of kind of how Google became Google, but it's kind of known within Google that one of the great secrets to its ability to scale was the early ability of Google to partner with other search platforms and actually provide a better ad solution, a better monetization solution than they were able to come up with, and that effectively allowed Google to scale in kind of exponential ways. And if everybody who's listening to this remembers the likes, the early days of the internet and the likes of Alta Vista and Lycos and all of the other search engines that used to exist, and they don't exist today, and a big reason is that Google came up with a way to partner with them, allow them to monetize at the same time as having, frankly, just a better product. So, it was just a phenomenal way to get to scale. It was a great example and they were sort of, a lot of those deals were like foundational deals in the early days of the internet. The Google AOL deal, for example, is, down in folklore as one of the most valuable kind of deals ever written in those early days. And so I think, the learnings have to be, one of the key ones is exchange of value, right? I think thinking really hard about not just what do you want out of that partnership with that other party, but what do they need in order to really promote and be successful. And what we see a lot, and what I see a lot, is a lot of partnerships that start with good intent but go nowhere, or you sign a piece of paper but actually don't deliver anything because there just isn't enough juice in it for either for one party or the other to make that party care enough. And so I think one of the great kind of learnings of that is really thinking hard about, is there enough juice in this deal for the other side to have them be excited about maintaining the energy on the partnership. And it's an easy trap to fall into as an entrepreneur or as a startup founder, to think about what you need and what would be good for you and whether or not this partnership will help grow your business. It's much harder to put yourself in the other shoes and think, what did they need in order to make this successful? And again, I think we spent a lot of time at Google in partnerships and in other places in my career thinking about the other side.
Yeah, that's great advice. I mean, I've seen that kind of from first-hand experience, both in things that I've been involved in, but also just speaking to a number of startups that, potentially want to chase the big logo name that they have a partnership with that, takes somewhere between 6 to 12 months to get across the line. But then once it's actually live and active, there isn't much, much result or ROI that sort of comes from all of the time and energy that's been spent in focusing on that. Again, just wanting to get your thoughts on how are ways that you can, I guess, gauge the juice on the side, as you put it, for the partner, and also what are ways once a partnership has been signed to actually cultivate that a little bit further.
Well, you know what? Like sometimes this is as easy as ask them. What do you need out of this? How are you measured? What does good look like for you? Again, those are not natural questions for people to ask necessarily, but they're really important. And making sure that you understand that. And if what you sense is that you're not going to be able to deliver that, then you need to address that right up front. Because what you don't want is to end up 12 months down the track realizing that, we're not going to deliver what the other side needs. So yeah, a key way is just ask. You can think in abstract about it and try and kind of hypothesize it and so on. But sometimes you actually just have to kind of get to the nub of it, to the nitty gritty. And there are some great examples of this. I remember in the early days, going back to that map deal that I was talking about, I think I can talk about this now. Maybe it's long enough ago, but we originally did the deal in Australia to replace kind of government map data for Google with Telstra's core infrastructure data. So maybe a lot of people don't know this, but the Google map of Australia is actually originally, had one of the key data points that fed into it, because there were many, was the base map data of Telstra. Back from the early days of mapping the copper wire, they were one of I think they're the only other source of sort of just core infrastructure data in Australia. So as we were doing that deal, at the time, Telstra and a thing called Where Is, which I don't even know if exists anymore, it might do, was the sort of, I'm going to say, dominant map player in Australia. And here's Google, the new player in the space, saying, we want to use your map. And you have to kind of think through, well, why would they do that? What would be in it for that player? And I suppose I can't go too much into the kind of commercials of that deal, but a big reason that we were able to get that deal made and get that done for Google was really thinking hard about what does that partner need. And Telstra has been a huge partner for Google, since the earliest days of being in the market. We did an original deal with Census for its Yellow Pages listings data. Google did early Android deals with Telstra. So the relationship with Telstra was hugely important at a kind of corporate level, and still is to Google. And so a lot of that comes to bear when you think about having that conversation around, say, something like mapping data, and really thinking through, well, why would they want to do this when they were the dominant player in the market, and so on. And so, yeah, I think that's a kind of a good example of where we might have done things like that. And I think for any startup out there thinking about how they scale, and who they want to partner with, thinking about what value you can actually bring to a partner is as important as what value they can bring to you. And it might not be and it could be the non-obvious stuff too. So it doesn't necessarily need to be. I think there's lots of ways to bring value to a relationship, right? Some are very direct and very obvious. Some are less direct. Some are cash. Sometimes you can just pay, but that's maybe the bluntest instrument of all.
Yeah, great advice. I love that. And I know that you sort of very briefly brushed over this, but I think that you've got a fascinating story as a founder, both prior to and after Google, and obviously prior to your time at ClearCo as well. Do you want to share a little bit about your background as a founder?
Yeah, it's interesting because as I said, I kind of started. I started not as an entrepreneur. I started in corporate. I worked for WPP, who were and still are, I think, the biggest advertising group in the world, and quickly realized I didn't want to work in advertising, and then found myself spending 13 years at Google, the biggest ad engine in the world. So that was a kind of a weird journey. But in the middle of that, I left and kind of said I don't want to be in advertising, and I'd met a friend who was a lawyer who had this crazy idea for a legal tech platform, and he sort of half built some initial tech. Actually, more than half built. It was sort of a kind of MVP stage, but and I worked with him to help him kind of bring it to market. I think it was about 2003 when we were doing that. So this is kind of, I like to think of it as kind of in the rubble of the .com crash. We were launching a legal tech which didn't even really exist as a concept very much at that point. It was a great time. It was frankly a great time to be launching a business like that, actually, and we had a phenomenal experience. I remember sitting in my living room and literally coding the first Google AdWords campaigns and putting tracking code on the site and watching with my own eyes, virtually watching the first click happen on the site and the first conversion happen, and being able to see the tracking code pop up, and realizing that we just spent 57 cents on a click that converted to $137 of a document, electronic document, and kind of went, okay, we can probably make a business out of this. And that was in the days when clicks only cost 57 cents on Google. Glory days. And I kind of was learning on the job, right? So, as most entrepreneurs or startup guys do, you're sort of learning everything for the first time as you're doing it. So I'd never actually been in. I think I'm right in saying that Google's AdWords platform had only just launched in Australia when we were on it. So we got super early. Was teaching myself all sorts of kind of ad tech, martech necessities to kind of get the thing to market. And we kind of bootstrapped the whole thing. And I say we, it was largely the other co-founders in the business that put most of the cash. And so, it was a days well before sort of a lot of venture capital was funding businesses like that. And it did phenomenally well. And so ClearDocs, as it was called, eventually we got a good exit and sold to Thomson Reuters, where it still sits today. And I often look back on that certainly very fondly. It was a great time, but also in just what the opportunity was and where we could have taken that business with the modern infrastructure that exists today, even in Australia for startups, with capital raising communities and platforms and businesses like ClearCo, not to spruik where I am right now too much, but businesses like we're in today that provide capital almost at the spin of a dime. I just didn't exist in those days, and so pouring lighter fuel on a good idea is much easier now than it ever was then, even. And so so that was my my legal tech journey in a period where legal tech didn't really exist. And then post Google, so that kind of led me to Google. And then as I came out of Google, I joined a co-founder at LionPay to take a role at white label buy now pay later, which was then and is now still an incredibly good idea. And as buy now pay later becomes ubiquitous, and it was not always the way, and even when I started there at the start of 19, the beginning of the pandemic, another great time to be kicking off a business. It was not obvious at that point that buy now pay later was going to have the ride that it's had over the last 2 years, but it was clear that it was going to be incredibly successful. But almost as soon as we kind of took LionPay off, and it's still very much around. the whole world just climbed on board the train. So in the next kind of 18 months, we at LimePay raised $30 million, hired the first kind of 50 people, brought the first 150 customers on board, and so on. And at the same time, all the banks were busy rolling out their own buy now, pay later solution. PayPal was rolling out its own solution. Shopify, everybody was rolling out its own buy now, pay later. It was going from an independent business kind of idea to a feature within giant platforms of the internet. So that's evolved incredibly well, but it was a great journey. And had a thoroughly good time launching that into Australia. So I suppose that's my startup journey, and two very different periods in Australia's startup ecosystem as well, right? What I found in that second experience was, as I was just saying, the platforms and networks and infrastructure that is available now in Australia to get startups going means that you can just move so fast, and you can build things very quickly, you can raise capital very quickly, you can burn money pretty quickly too, learned that. But that's actually a real problem. I mean, to be fair, I think sometimes when things come easy, it's clearly not always a great thing. But yeah, I sort of compare the states of the two economies, if you like, as being fundamentally different. And I think I always say, if we had ClearDocs now, in this day and age, we could easily have taken that business kind of global very quickly, and it would have been a very different state. But yeah, that's. I hope that answers the question.
Yeah, absolutely. And I mean, I think it's kind of fascinating almost comparing the two sort of experiences side by side. A couple of weeks ago, I had Nikki Skivak on the podcast, who you might be familiar with, from Blackbird, who was talking about, the challenges of raising their first fund in 2012, which was about 10 years ago. Your experience with ClearDocs was almost 10 years prior to that in 2003. And obviously, as you mentioned, a couple of advantages in terms of 57 cents a click on Google is incredible, but obviously a very different sort of environment and a different structure that you were trying to build the business in, which comes with both sort of advantages and disadvantages. But yeah, I'd love to kind of dive in a little bit deeper into that sort of experience in terms of what it looked like.
Well, a big one that people forget is trust, right? So the levels of trust of even providing your credit card on the internet at that point was so low relative to where it is today. I mean, it was still an issue. And we don't even think of that as an issue really anymore. Certainly not in markets like this. It's still a challenge in lots of developing markets that don't have card penetration or unbanked people and so on. But for us, if we're talking about Australia, trust was just a huge issue, and it's kind of actually a bit of a side note. It's kind of the issue that you're seeing in crypto now, right? Is because it's new and so early in its stage. Trust is a huge issue for that that ecosystem. But in time those things will be solved. I'm 100% sure. But yeah, so we had the challenge of kind of getting people comfortable with the idea of providing credit cards online. Then we had the challenge, and this was specific to, and it's still a challenge, I think, in lots of verticals. Trust of let's call it a digital platform replacing or supplementing or even working alongside traditional legal infrastructure, let's say, right? And in fact, I had a quote on my wall. It was the motivational quote I had on my wall for the longest time at ClearDocs, which was a quote from, I forget now who it was. I think he was the head of the New South Wales Chamber or something like that, head of Law Society New South Wales, I think he was. And he, when we got our first bit of media, and they quoted him in the piece as saying, it's very dangerous for consumers to rely on online these kinds of online services for their legal advice, right? And that was the view of the law at the time. And of course, I think where we've got to is a place where, and this goes the same in kind of lots of verticals, where people are realizing obviously that technology doesn't replace existing infrastructure. It enhances it in lots of ways, sits alongside or accelerates or even just amends and modifies and But I know there's a whole separate discussion you can get into about whether or not automation and so on is removing jobs, because there's a lot of debate around that. But I think my observation was that was just not the case, and what things like ClearDocs was doing, and you see this in lots of other verticals with similar kind of models, is actually creating a lot more opportunity, a lot more access. One of the big motivations for us for doing ClearDocs, and the underlying principle was the idea of making plain language legal documents freely available, as in much more accessible than having to go to a very expensive lawyer to get those drafts. So what we were doing was democratizing the access to plain language, which otherwise had been the domain of those that could afford to go to expensive lawyers who'd done the training and understood how to make. They weren't using 60-year-old precedent documents that were written in legalese and garble. And so I think that's kind of it's an interesting thought experiment to go down about how much technology and how much the kinds of disruption that we were introducing into the system actually create value, right? Like real meaningful value. And they don't. It still is my view, and always was the view, that they don't destroy jobs. They create value very, very much, and we're seeing that.
It's fascinating, sort of looking back at that, and your kind of point about the trust on credit cards. I feel like it's only really, if you think about it, only been over the last few years that people have felt very comfortable. And you've seen a really big jump in e-commerce, but 20 years ago, in terms of trying to get people to trust that, especially in an industry like law that is so ingrained in that relationship and that trust, must have been incredibly challenging. But as you mentioned, there are certain infrastructure that's available now that has its benefits, but also comes at a drawback as well. And really curious to sort of understand from I guess, having gone through both your experience with LionPay and ClearDocs now, do you think that the sort of lack of ease of capital was of benefit or a hindrance to ClearDocs at that time?
Yeah, look, it's a good question, right? I play that thought game all the time about if we had the money that I've no doubt we would have been able to raise if we had this idea today. I think we were incredibly scrappy. I think one of the things is we were afforded the time, because not having the money means you just move more slowly somewhat, right? And you just can't afford all of the resources, right? So, and I think we were afforded the time because there wasn't the competition in the space. It was an earlier day, whereas today the speed of acceleration is so much greater that if you don't move, you miss your window. Right, and we look at the buy now pay later space now. I mean, Afterpay pulled off an incredible magic trick of selling at the absolute peak of the fintech market, and so well done to them. But for those left in that wake, they've somewhat missed that window. They'll be asking themselves the question. If we had raised more, could we have moved faster? Could we have hit that window? Could we have, accelerated harder? And so on. Like, that's just the nature of the beast. And so I don't think there's not a good answer to this question. I think we were afforded that time, but I think as I look at us now, and I look at where I am now, maybe we'll get on to kind of ClearCo a little bit. So it's slightly confusing to have two businesses in my resume, both with Clear in their name, and a complete coincidence. But if I think about ClearCo, we're very much on that journey now. We took $200 million investment from SoftBank in kind of July last year. That's enabled us to get to scale in our market and scale globally, which is why I'm here, and so on. And it is very much a race to scale. And I can see within our business that we are constantly treading that line of trying to move quickly, trying to be disruptive, but also trying to be responsible with the capital that we have. We're very careful about. We do make bets on new ideas and new product, but we shut the bets down pretty quickly if they don't look to be paying off, and things like that. Like just being rigorous about the way that you think about headcount allocation, the way you think about growth, the way you think about unit economics of your business. We are spending a lot of time at ClearCo, which is critical, right? Because it is very easy to let those things get away from you very quickly, and I think that's probably, for a business like us now at our kind of scale up phase, I think you can blow up very quickly if you don't do that.
Yeah, and obviously, sort of recognizing that ClearCo is quite new to the Australian market as well. For the benefit of listeners that maybe aren't as familiar with what ClearCo does, do you want to share a little bit about the business?
Sure. So ClearCo is the largest e-commerce investor in the world. So a pioneer in the revenue-based funding space, pretty much created the category. It essentially automates the process of providing capital funding to e-commerce businesses who plug in their data into our systems, and we have algorithms that understand the model of e-commerce businesses and are able to make very quick judgments about whether or not we can make an investment. And then the investment is very, and we use the word investment very specifically because what we do is neither kind of debt nor equity specifically. We actually provide capital at a fixed fee repayment, and it repays over a set term, usually somewhere between 5 and 9 months, that kind of term, remitted from the e-commerce business's own accounts on a daily basis. So it's quite a different model to, say, a traditional loan that accrues interest and pays an interest rate and can roll over, if you like, and is a typical loan. And it's also different from traditional equity investing in that we don't take any collateral, we don't take any board seats, we don't own any share in the business. So it sort of sits somewhere between those two things. And it's been enabled by the kind of fintech revolution and I guess open banking in some ways as well, and the ability for us to therefore be able to provide kind of instantaneous almost decisions around funding to what is, I suppose, a fairly niche market initially, but I think there's 25 million e-commerce businesses in the world, so it's not that niche. And obviously, ClearCo's model is very much the I think where a lot of kind of business lending, for one use of another word, is kind of heading around the world, and there are lots of people in this space now. Some specializing in SaaS businesses, and some specializing in other particular verticals. But you're seeing the kind of I think you're finally seeing the sort of traditional banking model of underwriting being replaced pretty rapidly now by this kind of form of democratized access to capital. And we talk about democratization because what we found with ClearCo is that by relying on this data and by being, if you like, agnostic about the way in which we make decisions or being purely data-driven, we actually lend to, or we invest in 8 times as many women as traditional venture capital. And I think in the UK we did some research and found that we fund 25 times as many companies with people of colour as founders, because once you take the bias out of the process and you just look at the data, you actually find that you make very different funding decisions, I guess, than traditional models of capital. So it's a really exciting development too. It's creating access to capital in ways that, I know when I again, if I reflect back on my ClearDocs days, I wouldn't have known where to go. I was much younger as well, but there wasn't the community. I wouldn't have known where to go for capital. Traditional banks would never have even looked at that kind of business. There may have been secondary lenders and others that would have charged, extraordinary capital and required, collateral, everything and more would have had to been put on the line. So for founders now to have a way, and I think in the future as we point to kind of where the future of this is going, for founders to have access to capital and not have to put their life on the line and also not give up enormous chunks of their business is actually a really exciting path forward, and I think can light the blue touch paper under the space that we're in.
Yeah, absolutely. And for anyone that's been listening to the podcast for a while would know I'm a huge fan of just there being more options, whether it be for capital or otherwise for founders. And, love the approach that ClearCo's taking, especially, as you mentioned, really focusing on the data more than anything else. Do you want to share or elaborate a little bit in terms of the process for ClearCo in terms of how you make investment decisions?
Yeah. So in some ways, it's very straightforward. If you're an e-commerce business, you connect your Stripe or your Shopify account, whatever's processing your transactions, and we also typically ask that you connect your ad platform data, because most of the investments that we make are specifically allocated for either inventory purchase or for marketing purchase ads, and we find that if founders or e-com businesses connect those two things, we have algorithms in the background and models that allow us to very quickly make a decision about what the trend lines of this business look like, how they match versus similar businesses that we've seen in that vertical, both in the market and internationally, perform, what the likely future performance of that kind of business will be. And we can come up with offers within, potentially within minutes. And and we do that with a very high certainty because we have all the downside risk. So the thing about this is, if the funding decisions we make essentially come risk-free for the founder. So if we make the funding decision that we'll lend $100,000 over 6 months at our typical fixed fee rate, and that money gets invested and doesn't drive the growth that our models had forecasted, then it could just take much longer to pay back, and that's our loss. And that's the bet that we make every time we back a founder. And we have pretty low default rates, so we're pretty happy with that backing data works. I think as Michelle Romanow, the CEO, talks about, I think in the early days it took some heavy losses to train that data, but you learn pretty quickly. The models learn pretty quickly what works, what doesn't work, what businesses are trending in the right way, and particularly the ad data is particularly important. So really understanding training the models to understand the unit economics. If you're a fast fashion online retailer, we've seen thousands of fast fashion online retailers. We know what the CPCs are. We know what the unit economics look like. We know what how those businesses should perform, how they trend, what their seasonality is, and so on. And we can make pretty good decision pretty quickly about exactly where they're at. That is very different to how a traditional investor might look at a business like that, or at least their ability to be able to rely on that amount of data, in a really algorithmic way is nowhere near that.
Yeah, I guess from an equity investor perspective, so whether you're an angel or a VC fund, you're kind of generally sort of forward projecting in terms of here's the current state of the business, here's what it may turn out to be, over an extended period of time. But I think it's a really sort of interesting take of having a specific model that you can sort of look at and assess businesses. And I guess from your perspective, you're trying to gauge whether this business has the right infrastructure framework and the right set of metrics to be able to pay back the loan or the capital that you're sort of providing to them. Obviously, without giving away your sort of secret sauce or your algorithm, can you share what some of the sort of key areas of that are important for you in investment decisions that you make?
Yeah. So one is we need 6 months of data from the founder, because we need something to train the model with ourselves. So it's 6 months of data above, we'd normally say 10,000 a month of kind of transactions, so a reasonable data set. And then the ad data and the unit economics are really important. So how healthy is your ROAS on ad spend? How healthy is your inventory turnover? And so on. Is it costing you $2 to drive $1 of sales? In which case, it doesn't sound great. If it's costing you 30 cents, maybe that's better. So yes, we have a bunch of those kind of ratios and metrics. And my advice to anybody, if you're in the e-commerce space, is, and this was always the advice, at Google as well, is you need to know those numbers for your vertical. And so one of the great advantages actually of being with ClearCo, and you can plug your data in for free without needing to take any funding, by the way. So if anybody's listening to this and wants to go and just connect their accounts just to see this data, they can. Knowing those, because we externalize, we make available through the platform your benchmarks immediately. So if you plug your ad data in, you will see your benchmark, how your data performs against the benchmarks for your vertical. You'll see. And that is incredibly valuable to know. And you can get some of this, I think, from Google Analytics and others, but not in the same way, and not in the way that we might surface it. So I think it's incredibly valuable for e-commerce founders to know, how their expenditure and so on is performing relative to the market. Where are they in the benchmark wise on a ROAS basis and so on. And those are things that I think you just absolutely have to know. And I think any sensible kind of e-com owner would know that.
Yeah, and I guess, as you mentioned, extremely beneficial to have a baseline across the industry in terms of, getting a gauge from where it is that you sit. I know from a founder perspective, it can be a very sort of isolating journey of your own specific metrics, but you have no idea whether you're performing well or not in comparison to the rest of the market. For anyone that does sort of decide to plug their metrics into ClearCo and gets something that says that they're not performing to baseline, do you have any advice in terms of how they can drive more return on advertising spend, or just specific metrics in general in terms of what they can do to improve the overall performance of the business?
Yeah, actually, so again, and we get asked that all the time at ClearCo, and so one of the things that I'm really bullish on is again, this is why I think partnerships are so important, right? Because one of the things you get when you get funded by ClearCo is access to our network of partners, and we're building those out all the time, and hopefully those are best in class kind of either agencies or venture or it could be third-party logistics providers or whoever it may be, but you quickly get an infrastructure. And so I think and ClearCo is still a very new business relatively, even though we're the largest in the space. I think as I project forward where this is going, I think you're quickly going to have hubs of ecosystems, if you like, surrounded by best in class, best in breed partners, to be able to say, okay, if I'm a DIY vertical e-commerce player, I want to see what are your recommendations for partners based on data. So not based on relationships and opinion and reviews, but based on data. Who do other DIY retailers use for X or Y service, right? I think that's unbelievably big opportunity, is to be at the center of that decision-making process, driven by data, to be able to say, well, 37%, go with this partner, or people at your stage of life cycle stage, right? So you're in this stage of kind of life cycle. You should probably be thinking about investing this much with these group of partners who are the right. Because often that's the question that you get a lot. It's easy to answer your question specifically. It's easy to say, well, you should just go to agencies, you should go to third parties, get advice and so on. But who, right? Which ones? And how do I know what the right amount to spend with them is? And what does good look like there? And so again, being able to make those decisions with data and actually be able to say, well, here's actually some data around what who is using the ecosystem and where they're investing, what kind of tools they're using. That's still a very big problem on the internet, right? And it's not a problem that Google has solved. If you, it's a very famous difficult queries at Google are things like, which real estate agent should I use? If you can take that example, right? There's no good answers on the internet for those kind of things. And I think the next stage of kind of where we need to get to is data-driven decision making about those kinds of things. And so I think for us, we can do that with e-commerce very well. We can start to provide real data on where to invest, I guess, in the ecosystem.
Yeah. If that's a forward projection, I'm really, really excited to see what ClearCo comes out with on that. I think that's going to be hugely beneficial for a number of businesses as well. I guess just kind of picking on that point, someone that I spoke to as part of the research process for this interview was Scott Riddle, who you hired twice, I believe.
I did, yeah.
Yeah, great guy. He mentioned that not only, one of the things about you to kind of pick on was your incredible wine cellar that you have, which I will need to check out potentially next time I'm in Sydney. But one of the other things that he mentioned was your ability to build high performing teams specifically, and I think that's something that gets really thrown around a lot, both from a VC or from just kind of general advice. Is you need to have A players, you need to build the right sort of team around you, but it's really hard to kind of as an early stage business to really understand what that looks like and how to actually build that team out. Do you have any advice in terms of how founders who are at the early stages, that it's potentially just the initial co-founders and they're starting to build out their team, what they should look for and how they should structure that?
Yeah, look, I've got to be honest, right? I've got to give a lot of credit to training at Google for that, right? Because I don't think that was a natural thing for me. I mean, some people might be, true naturals at kind of leadership and so on. I'm kind of in the camp of I was most definitely kind of trained, and sort of dragged into that process. Like I think as I said at the opening of this, I kind of said I feel like I'm kind of much more naturally the kind of entrepreneur type, which is just go do, right? And and I think for a lot of the people that maybe listen to this podcast, you fall into that bucket, right? You very much bias to action, get shit done, go do, right? Which is not a bad thing at all, but probably what then you lack is that ability to sit back, to quote unquote lead and think about what other people's needs are and how you're going to amplify the performance of your team rather than just your own activity, right? And so I suppose the advice is if you feel like you are that kind of person, which I think a lot of as I say, if knowing your audience, a lot of the people might well fall in that bucket. Having the self-awareness to know that that's who you are, and therefore either hiring people around you who can fill those gaps, or very self-consciously taking the training. So I did my MBA. That was very helpful for me. And as I said, Google provided phenomenal training as well, to really just kind of learn this stuff, right? And for me, it really was learning. It was like just quite mechanical in some ways, of kind of just really being told about the things you need to do, in order to ensure that the people around you have the things they need to be successful. In order, really think about how scale happens in a business, and it doesn't always happen from you just doing more, right? And that's again the bias for me and for lots of other people was just do more yourself, and then quickly you start to realize no, actually that tops out pretty quickly, and you need to think about what are the skills you need around you, and how do you help them be successful? And it's a thing for me that I consciously, I think I've got better at it over the years, and I think I really do believe it's a learned thing. There are some people you come across who are just incredibly naturally gifted that way, and I'm in awe of those people. For me, it was a learned skill. My MBA was a great training. I'm often an advocate for them. I'm one of the AGSMs. I did it at this graduate school of management at New South Wales, and I think I'm one of their official kind of advocates. And for me, I did a degree in I had my undergrad was Masters in Literature, and so I indulged myself for 4 years in some fantastic reading, but didn't learn a lot of kind of business skills. And so when I came out of my first, as I was just coming to the end of ClearDocs, I was thinking, okay, I'm heading into probably something that looks a bit more like a real job here. I'd probably better get some skills, and decided to do my MBA. And for me, with my background, that was unbelievably valuable. So I often get asked by people I mentor or people in my teams, should I do an MBA or not? And I think for startup founders, my advice, if they're listening, would be to really think about the skills that you're missing. So for me, I was really missing the core business skills. I'd never done a business degree. I'd never taken a business course. I won a national business ethics essay writing competition when I was at university, but that was more, I think, by chance than anything else. for me, I'd never taken a corporate finance course in my life. I didn't understand the basics of one-on-one accounting. So it was unbelievably valuable for me. It may not be if you already have those kind of basic training things for you as a founder, but then maybe there are really some more formal kind of trainings to do. But I wouldn't underestimate how valuable and how big the blind spot might be that you just don't recognize, right? And I'm all for kind of leaning into your superpower. I believe in that. I think it's important that you kind of play to your strengths and all of those things. But I think it is important to recognize if you have big missing chunks in your education, that rounding those out can be hugely beneficial.
Yeah, and I really agree with your point in terms of hiring, especially being a learnt skill. I think back to my first startup. I had zero experience of ever going through a hiring process myself, let alone having to create one when I was hiring people for my startup. And a lot of it is just almost a lack of exposure to kind of processes and structure. And as you said, similarly for me, AWS was an incredible experience to kind of learn what does this look like at scale. Are you able to share, some of the processes or things that you learned from your time at Google, or what you learned from your PhD? No, MBA.
So in hiring in particular, really interesting thing at Google. So they, famously, right, at the beginning of the journey of Google, the hiring was unbelievably arduous, right? It was, weeks and weeks of interviewing and, crazy kind of management consulting style question and answer interviews and so on. And then they did a whole bunch of, apparently, years later, they did a whole bunch of kind of regression analysis and looked at the performance of candidates over time relative to the grading they received through interview process, and where the cutoff point where you got no further value out of the interview process was, in terms of future performance. And it turned out that number was 4. Like 4 interviews was basically it, right? After that, if you got no actual, future benefit out of that. So that was a great lesson. It's like you don't need dozens of interviews. You need the right 4 interviewers, a good cross-functional and diverse panel that really truly represents the culture that you're trying to create and the skills that you need, and then a hiring process that drills for the key things that you're across a range of kind of. So Google was at the time I was there, and I think it's changed now. Had kind of 4 key areas that it was trying to hire across, and they were very particular to Google, not really, but kind of, one was culture and one was leadership and general cognitive ability and so on. But yeah, and everyone was aligned around those things. That's what people were hiring for. But a great learning was it doesn't need to be weeks of interviews, and it doesn't need to be dozens of people. You can get you will get the great result out of less. The other thing I will say, honestly, is, I think as I've got older, I think you can have a great hiring process, and you can tilt the odds in your favor of picking the right person and so on. There is a certain amount of luck involved, is my sense. You have a feeling about someone, you meet them for 45 minutes, you read their CV, you make some assumptions, and then you're really taking a punt on someone, and you're then giving them all the support and giving them as best you can all of the tools and all of to make them successful. If my next for a founder, I would say is, those first 3 months, you need to make decisions very quickly about people, because you can't afford to keep people in your business that aren't right, and both for them or for you. It's just a bad outcome on both sides. And in a larger organization, you can afford to say, listen, this person is great, but they're not in the right role. Let's find them the right role, and you can do that. In a startup, you don't have that luxury. You don't have dozens of roles in 12 different departments across, different jurisdictions that you can kind of move people around to find them a home. So it's so much more important that that you get it right first time. That's, again, there's some luck, there's some judgment, but then B, you make decisions quickly for both parties if it's not working out. And I think you learn that the hard way if you're in a startup, because sometimes you make the wrong decisions and you keep people too long, and then it's bad for everyone. I think I've probably learned that lesson sometimes too.
Yeah, I think the best part about the processes is trying to weed out places where it leads to bad judgment. So one of my favorite things with Amazon is the last process that you do 5 1-hour interviews with 5 different people in a row. Is one of those people is a bar raiser. And so they're not connected to that specific area of the business as well. And all they're judging is on fit culturally within the company. And so what introducing that person to the hiring process means is that instead of a hiring manager who's desperately looking for someone to fill that role and is just saying, this person's kind of good enough, we just desperately need someone. If they say no and everyone else says yes, it's a no overall. And I think James Chin Moody as well from Sendle, when we had him on the podcast, it was a really big advocate of having hell yes through the hiring process. So everyone that they interview with has to be, it has to be a hell yes from them from a hiring perspective for them to go ahead with it, because making the wrong hiring decision, unfortunately, can be far more costly in the long term.
Yeah, 100%. And I agree with that. It is a luxury in a larger organization, not a luxury, but it's a thing that you can do in a larger organization. And I think, in a startup, it's harder to hold yourself accountable to that, and you don't always have the luxury of choice either. At a company like Amazon or Google, you have millions of CVs, you have unbelievable talent at your beck and call. When you're in a startup, sometimes you're grateful that anyone responded to the ad, and if they did and they fill the criteria, then great. So that is fortunately not the place that we're in right now with ClearCo, but it has been in my startup journey. And you're asking people in a startup, you have to kind of understand you're asking people to trust and to throw their livelihood in your hands, right? So, it's a big ask of people, and so for the candidate too, right? And so again, making sure that fit. Maybe in a lovely circular moment, it maybe brings you to the point that it's kind of a partnership, right? And there has to be value in it for both people and be the right fit. And I think every recruiter will tell you that. But as you say, the temptation is to hire the person that gets you what you want. But if you sense that it might not be right for them, that's a red flag, right? And I would urge people to think about that pretty hard.
Absolutely. And speaking of value, Dan, thank you so much for coming on the show and for sharing your extremely valuable insights and experience for listeners of the podcast. For anyone that wants to find out more, or if there are e-commerce founders that are looking to get an understanding of the baseline metrics or potentially get capital from ClearCo, what's the best way for them to do that?
Well, go to the website. So search ClearCo, ClearCo, CO. And I'm on LinkedIn. Hit me up. Feel free you'll find me. And I think that's the best thing to do. If you're an e-commerce business with 6 months or more, you probably qualify. So, why wouldn't you come and find out?
Absolutely. I will make sure all of those notes are in the show. All of those links are in the show notes. Dan, once again, thanks so much for coming on the show.
Really enjoyed it, Rohit. Thanks very much.
Cheers. Thanks for listening to episode 162 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.co. This week, I've also launched a new newsletter where I'll share details of the latest episodes, as well as creating additional content where I'll dive in deeper into some of the topics and themes that we cover on the podcast. You can find the newsletter at startupplaybook.substack.com. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.